Good morning. Thank you all for joining us in this discussion. Generally, we don't do too much of this because of the personalized and individual interaction that constantly happens between our investors and our team. But I believe that we are in circumstances which are quite extraordinary, where the market is more polarized than I have seen in the past. The only time when the entire market was polarized was in Harshad Mehta's time, where anything which had the name of stock went up. But after that, we have seen polarized markets, but not to the extent we have seen now. Effectively, in every market cycle, whether it is 94 during the GDR boom or 2000 during the tech boom or 2008 during the infra and power boom or 2018 during the small and mid cap boom, we had parts of the market where we could see opportunity. So those parts were quite large. Large parts of the market were ignored, and the boom or the euphoria was in a narrow part of the market. So that has been our past experience. In this market, we are seeing more parts of the market in the euphoric zone and less parts of the market in zone of valuation, which we like. But whatever be the opportunities before us, my firm belief is that in every market context, we need to adapt, we need to evolve, we need to identify opportunity correctly, and we need to try and capture whatever opportunity suits our risk appetite in our portfolio. If you ask me, I managed to do that very well when the markets came off a highly euphoric state. So when the market keeps coming down, in the past, I managed to capture it very well. The reason is that right during the euphoric state of the market, we were preparing for that. So when the euphoria came off, we were able to go headlong into whatever we were having high conviction on. So the conviction in the parts of the market which are ignored, where we see higher potential in the future, has to be built exactly when the euphoria is high. Only then one will be able to capture the opportunity in every market. I'll give you an example. Last year, when we had this COVID crisis, before that, we had already built our convictions to a higher zone in power and natural resources. We had already begun to initiate investment into infra. So when the markets fell, initially we had a lot of fear, but after the fear stabilized, we were able to increase our positions in these teams, and you are seeing the results. I know a lot of hype is there around the Nifty, but many of you may be knowing already. I'm going to say this for those who may not have noticed. The Nifty in the last 1 year has moved up by 58%, but the infra fund which we have bought for our investors has moved up by 68%, and the natural resource fund which we were investing has moved up by 78%. But to capture this opportunity has not been easy, because if you notice, if you look around, most of the people are entering this only now, right? Whereas we have entered it well before others. The reason is that when we see an opportunity, we are very early. We build our conviction during the early phases so that when the opportunity becomes clearer and clearer in our eyes, we are better placed to take the maximum out of it and to get the full value of our conviction and our effort in creating our investment. So opportunity is always there, but to capture it, it calls for a lot of preparation. And this is not limited to the context of the last market. My experience as an investor in every market cycle has necessitated this preparation. So without this, capturing the opportunity is very, very difficult. So in every market cycle, even if it is euphoric times like we are now in the middle of, or moving more into, you need to prepare for the opportunities of the future. That is basically what I am emphasizing when we talk about capturing opportunity in every market. So how do you participate in every market opportunity? That is what we are going to now talk about, because knowing there is opportunity is one thing, but participating in it is an entirely different subject. So to participate in every market opportunity, it's not enough for the advisor to be prepared. I know a lot of people think that I given them money, let them find a way to participate in it. But money which is invested already may be dedicated to an existing theme which is running at its own cycle. Like let's say you are invested in gold. Gold is invested for a specific purpose, that if there is a rise in interest rates and if inflation goes up, at that point in time, gold will start delivering the stability to the portfolio. You saw it last year also, right? So it's there for a purpose. So you can't disturb that investment to create another investment. You need to actually ensure that to participate in every market opportunity, you always contribute liquidity to your portfolio. So to participate in an opportunity, creating the liquidity in advance is very, very important. Let me explain. I have identified a new theme. Now I need to start a position in the theme. It may be somewhere between 3 and 5%. Based on your risk appetite and your risk profile, if that suits you, then I would be starting a position in that theme. What I have observed is that most people first debate whether they should participate in that opportunity. Now, a lot of time gets lost in this debate. I know a lot of conversations happen. Now, what are these conversations based upon? Broadly, they are based upon market information. So you will be hearing a lot of things which need not necessarily tally with what we are telling, and the noise which you receive information from in the market will be way higher than the way we are going to present the theme. But still, you have to participate in every market opportunity, because I have seen in the last cycle, when the market crashed, the belief that I had was that tech is a space where you cannot ignore, because work was going on, productivity was going on. In fact, we could see parts of the tech universe benefiting from COVID. Though COVID is a crisis of monumental proportion, we could see clearly that some of the tech companies, domestic and global, were clearly benefiting. So our team initiated this discussion to participate in tech, but nobody was willing to put in extra money, because in my mind, the position size was, okay, I am highly convinced if I want to put money in NASDAQ, I should put a 10% bet, right? A 10% bet in a NASDAQ was what I wanted. But effectively, what I saw was the average bet size was not more than 2 or 3%, not even that actually. So people were not understanding how to participate. They were wanting more evidence to participate. But such a juicy opportunity, like what we saw last year in tech, doesn't need any further evidence. You have to begin, and you have to use incremental evidence which you are seeking whenever you find it to scale up. To start itself, you can't wait for evidence, because by the time the evidence came, stocks are moved up by 40-50%, and then I am not going to start the position, because in the model that we follow, the primary need for us is to be early. If you're not early, then we have lower margin of error. So for our investors, our advisory approach would be to start early. But many times I find that we are not on the same page because we are debating the merit of the idea. We have to find a way to resolve this, and it's bilateral. But I am firmly of the opinion that if you have to participate in every market opportunity, you need to first buy in quickly to the idea, subject to some kind of restriction on the position size, and then increase your conviction and participate. But if we are going to not open our minds and we are going to resist the new idea, then we would most likely end up missing the entire team itself. And that has happened to quite a few people in the last cycle, especially in tech. And that's something that has been bothering me a lot because ideas don't come easy, and the opportunities like this are like fat pitches in baseball. You can't expect that you miss this, you'll get the next one. It won't happen. So it's very important for us to understand the psyche of the advisor and to match it with our own investment approach and our own risk appetite and what is suiting us, and still ensure that some common ground is found and participation is ensured. That's very, very important. As we speak also, I know there's a conversation going on a global team, and for the last month or even longer, I have been watching the number very closely because the position size which we have initiated in that is a very small position. Yet we are not seeing people believe more in the idea. Okay, so they're still thinking, saying there's no money, or I don't know the reasons which each person is giving, but we see clearly that we are not moving in the direction that one needs to move, right? Because you want to get it right and then buy. We want to be perfect buyers. Now, the job of helping you how to buy right is the advisors, right? So at some point in time, we have to let go of that and allow the advisor to take that. Okay, with the kind of noise around us, it will be very, very difficult to judge a contrarian advice in this market. It was always difficult. I have seen always that people would not accept contrarian advice, but now with so much of consensus in the market, people thinking one way, this has become even worse. So as an investor, you are actually at a disadvantage in the current market context because there'll always be so much noise that noise will completely overshadow the kind of conversations people like us have with you. So you need to really believe in the process. You need to believe in the advisor. You need to believe in the merit of the advice and then start somewhere. So how do we succeed in this? Definitely buying is an art, and I'm going to talk to you about the art of buying next, because unless we get to that, we are going to have a problem, right? So how do you ensure that you participate in every opportunity? At the same time, you don't put too much money too soon, or you don't buy too much in a particular theme or an idea, which becomes a risk to your portfolio. So how do you manage all these things? So that is an art, and that is where our experience has taught us a few things which I'm going to share with you. First point, keep some powder dry. Always keep some money in your portfolio. If your portfolio is fully invested, add 10%. Let's say you put 100 rupees, add 10% and keep that money dry, right? Understand from your advisor where he is going to invest it, or tell him this money is meant for this period, right? So use this money. Don't expect me to contribute anything for the next 1 month. And in this period, if you find some opportunities, you can tell me and you can buy it. That should be the simple approach to first ensure that you are ready to buy. Okay, when you keep some powder dry, when you keep liquidity in the portfolio, you are ready to buy. Let's move on to the next point. The next point is set clear targets. Many people are not clear how much money they are going to add to the portfolio. Set clear targets for yourself. Let's say we are in September 1. Be clear how much you have contributed in the first half of this year. Be clear how much you're going to contribute in the rest of this month of September. Let your advisor clearly know that this is the money I'm going to put in this month and this is the money I'm going to put in the third quarter. When you give this clarity, then he knows what to expect from you. Many of you do this, which is why the advisor is actually able to clearly ensure that you participate in every theme which we ideate. So set these clear targets, have this open conversation with the advisor, and then let the advisor buy when you see the target. That's very important. I saw this peculiar thing, but this happened in selling. There's so much noise on pharmaceuticals in the last 6 months, right? There's huge noise even in hospitals, but pharmaceutical, there's too much noise in this sector. At the time when the advisors were telling that maybe we should take some money off the table, there was a hesitation because on wherever you are seeing, I don't watch TV, so I don't know what's on TV. And I definitely don't see the likes of CNBC Awas, which are louder than the regular English channels. So, but my sense is that a lot of noise is happening in some sectors where there is huge consensus trades happening. Everybody is buying the same stocks. So selling becomes a problem. Similarly, buying also becomes a problem. In our case, when we bought natural resources, we had reached a certain position size. We wanted to increase the position size when the target was reached. A lot of investors were hesitant to either put in more money, even though the target is reached, or allow us to buy that. The approvals were not coming. In some cases, people were over layering their judgments on this. But see, I don't think that a contrarian investment model works well when we do so much of layering and stuff like that. We really need to move towards decisions, and you need to at least participate to the size that suits you, right? And you should not oversize. This is very important. See, the position of any one fund should not become too large. Any one investment, it could be a fund, it could be a stock, it should not become too large. And that is our responsibility. And it can be managed, and we are doing that quite cautiously. So avoiding oversizing is a very, very important thing in position sizing. Set your positions to some level and don't make it too, like I don't want to have a single team or stock at some 40% of the portfolio. Now, funnily, Nifty is 40% financials, which in my opinion is oversizing. Okay, whenever the oversizing has happened, Nifty has not held well, right? If you take 2000 in tech, despite the best companies which have done extraordinarily well in 21 years after 2000, that oversizing of 2000 affected that sector for 11 years. Infra was oversized in 2008. 12 years infra has suffered. So today, financials and FMCG is oversized. I'm not saying they'll suffer for 12 years, but I'm saying that the impact of oversizing them in your portfolio, even in a Nifty, is bound to impact. So that is something that I have seen and I am convinced will happen again as well. So oversizing is a risk. So you cannot have too much in one theme, which affects your portfolio. No 30, 40%, right? The next point is that never stake too much at one time. This is a very important thing. I mentioned about startup position of 3 to 5%. And then at every point in time, we keep raising this position, right? You will all remember that at an NAV of 20 or even lower, we bought natural resources and we had started buying at even 30 or 32. To give you a sense, today it's closer to 60, right? So 57, it's at a very high NAV, right? It's double, but the last layering of that investment happened at an NAV of 20 or sub 20, right? We could do that only because we were not invested too much. And many of you have been with us for 10 years, so you've seen how we used to build positions. Earlier, it used to be very slow driblets, but now we do it in a reasonable position size so that you are not burdened with so many approvals and it's not becoming a headache, too many SMSs and too much noise. So we reduced it and optimized that to a point where we don't overstate, we don't oversize the positions, we don't oversize individual installments or portions we build into an idea, and we buy when we see the target. We have very clear targets and we always keep some powder dry. This in essence is the art of buying, which is already built into your portfolio. Your portfolio may be 25 lakhs, but all these aspects are already working for you. And we have not really come and told you this, but there is a need to tell you, because otherwise most of us are only seeing headline level, and we are only seeing headline numbers. We are not seeing the process. And clearly, if we want the headline number to improve, which I definitely want for every investor, then the understanding and buy-in of the process has to be very high, because what we do in the process is only going to bring the headline number. So how we regularly contribute money, how we keep the powder dry for every opportunity. So there should always be some money in the portfolio. How we know the clear target. This is the advisor's responsibility. How we buy a small portion when we see the target, and how we don't oversize a position, and how we never stake too much at a time. We don't buy 15% in an idea, whether it's a fund or a ETF or a stock. We don't do everything in one go. So these are some of the things which really help, right? So this art of buying is actually working in every RIA portfolio of ours, where the investor keeps contributing money regularly and understands and believes in the process. If this is happening, certainly the investor is best served. So that is the art of buying, which we need to appreciate better. Now, to judging advice. Every investor who has an advisor has both a right and a responsibility to judge advice. Okay, but the way in which this is done is very critical, right? If we are just going to look at the headline numbers and judge advice, then we are not going to take advantage of opportunity which is brought to our notice. For example, sometimes the returns will be notionally lower, like there would be some temporary drawdown, the portfolio will be down by 10-15%. Some of the big themes may be down by even a higher number, but Nifty may not have fallen, right? Something like that could have happened. But the important thing is that you need to understand the strategy and how it's being built, and you should not layer what you hear in the market with this, because contra strategies are not going to be spoken by headline media. It's never going to happen. Okay, so if we are going to look at getting inputs from headline media to layer onto a contra strategy, certainly our interest is not best served. So avoid layering those opinions which you collect socially onto the advisor. Understand what the advisor is trying to tell you, right? You understand his perspective. Why is he saying what he is saying? What is his conviction based on? So once you have that conversation, then you are positioning yourself not to layer. Instead, you get into the zone of either accepting through appreciation or engaging to understand better. So the engagement will rise to a higher level. This is what I mean to say when I emphasize that you understand the advisor's perspective. The next point is very, very important. An advisor can come to you with an idea. Buy this theme, buy this fund, buy this ETF, add to this strategy, buy this stock. So many things we may come and tell you, but you need to ask yourself whether the risk suits you, because there are a lot of people who cannot take the risks which an advisor takes for himself, right? This is something which in our model is actually taken care of, but I still emphasize that you ask yourself that question, because independently, that is the justice you are doing to your role in the advisory relationship. So ask yourself, now let's say this team is telling go and buy reform. They are believing that this government has no option but to reform. They will sell public sector units. They are talking about selling so many companies. Whether that risk of whether the government will succeed or not suits you, right? You have to ask yourself that question and satisfy yourself that the risks are suiting you. Importantly, how do you do this? That's very important, right? Many people think, oh, what if disinvestment fails? In fact, the last time disinvestment succeeded in 2003-4, it's 17 years ago, I was having a negative view on disinvestment. I felt that disinvestment won't succeed, right? And I held to that view right to the end, right? the impact was quite devastating, to say the least. A friend of mine put 2 crores of his money on all these disinvestment stocks early, right? He was waiting from 97 onwards. He had bought MMTC at 97. So you can believe, whenever 97, 98, he's waiting. 3 years gone, 4 years gone, not making any returns. His 2 crores is giving him only dividend income, right? He's living off dividend income very comfortably. Long wait. Then I am telling that this government will not do. I am actually layering a political view of mine in which I did not like the then government, which was the NDA government. So I am layering my political judgment on them and saying that these guys won't do anything. They can't do. Their finance ministers are like this. They are not telling what the market likes to hear. So many judgments which are all political. But one thing was very clear. The valuations were so cheap that for my style of investing, it was right up there, right? The disinvestment, if it happened, I knew very clearly that it was in my zone of investment. In fact, it was more favorable than even I am willing to pay. It was right in the middle of where I should be. But I was not asking the risk question, but I was layering a different judgment on that situation instead of asking myself the risk question. Today, I believe that it's very important to only ask yourself the risk question. Does the risk suit you? Valuations are obviously cheap already. Okay, this part of the market is already cheap and it can't get any worse. A lot of reform has happened. Government is the only investor standing in this economy through 2020 and 2021. In 2022 onwards, Mr. Ambani is going to put in a lot of money. The Tatas are going to invest a lot of money. A lot of money is going to come in from outside in the form of InvITs. And government will still be the big man standing in investing in India, right? So it's very clear that valuations are not reflecting the investment merits, the capacity to grow, the appetite for growth of even public companies. Perception is driving this whole trend by people who want to believe that their political view will translate into an economic view, right? This is the mistake I made 17, 18 years back. And when you make a mistake like that, you need to wait for 10, 15 years for you to get a chance again. And that's what happened to me. And it's that learning that we are bringing into this situation. Interestingly, COVID has been a blessing in disguise. The risks suit you. So what should you think next? If this doesn't happen, what will happen to my money? Because I have bought reform as a team. I am in PSU. I am in infra. If this fails, what happens to me? So that's where you have to apply a filter. And that filter, which I say, is that heads I win, tails I don't lose too much, right? Even if the companies don't get sold, let's say BPCL doesn't get sold, you still get very high dividends. It's a strong company. It's a company with very good fundamentals, and it will continue to do well, right? So when you buy a fund which has got good public sector companies, even if they don't get sold, they still have value. And if they get sold, I'm going to win big, right? So that's a very good place to be in the investment world. Heads I win, tails I don't lose too much, right? So that's the filter that you need to apply when you are judging this situation. And then remember that in these situations, the conviction of the advisor may be higher than yours. I saw a lot of people arguing on pharmaceutical. Because in 2017, in 2018, in 2019, it was not doing anything. We had already spent 3 years in that theme, gradually scaling up. A lot of friends were saying that, oh, this is not so great. Why can't we do something else? Why can't we buy this? Why can't we buy that? Based on what is topical. Our conviction is higher than the investor's conviction, but that's not wrong or there's nothing good or bad about it. But you have to just appreciate the fact that our conviction will be higher than yours. So how can we bridge the gap? We both have a responsibility, right? So look for evidence that will raise your conviction, right? We are saying something, you look for evidence, you seek evidence even from us. That's fine, right? So or you can read about the best companies, find out. You can always spend some time if you don't want to blindly listen to what we say. You can always raise your evidence. You can raise your conviction through the evidence that you gather, or you can seek, and then you seek. You look for more conviction as you get more evidence. So that is something which is very, very important, right? Once you are there, right, your judgment of the advice will be very, very correct. You will not be wasting time. You will not be wasting energies. You will not be influenced by what other investment managers tell you, because they have their own approach, right? Which may be good, but that does not mean the approach we are following through a contrarian and a value-driven investment approach is wrong. It doesn't mean that. Our thinking has a certain cycle time. Okay, that cycle time will play out between 3 or 4 or 5 years. It will take, but at the end of that period, we should be ready to take advantage of the effort we have put in collectively and the time we have spent with the investment and the money that we have deployed. All these three things should translate into good results. So judging of advice should happen in such a way that it facilitates this whole thing, right? That's very important. Only then you can make advice work for you, right? That's what we're going to talk about next. Making advice work for you. So the advice is given, you have made the investment. What next? This is a question before everybody, right? So the first thing which I see is that somebody makes the investment and then starts looking at what happened. So I had this peculiar experience with some very knowledgeable professionals in their field. They are very, very respected, very knowledgeable. But when they come to invest, their anxiety level suddenly spikes. So what happens is that they make the investment and then next month they start looking at how's the performance. Then they start comparing with something. So this process is not going to help. So where I made a lot of money as an investor, where my investment success was the highest, inevitably there was a certain pattern. I'm going to talk to you about that pattern. First, the investment went down a little bit. Okay, sometimes it went down a lot, like 2020. So we lose 1/3 or even 40% of the investment, particular investment. Portfolio doesn't go down, but that investment goes down. And then it comes back. And then it starts going way above the valuation of the business in its intrinsic level, right? So the only way in which you can make advice which you have received work for you is by setting longer expectations. You can't look 1 month later, 3 months later, 1 year later. Generally, you look at whether an advice in one idea or theme works well over a period of 4 or 5 years. If it doesn't work in 5 years, probably won't work, right? Generally. So give yourself time. Another thing which is important is in a portfolio, there will be multiple advices. There'll be a gold, there'll be a mining, there'll be a natural resource, there'll be an FMCG, there'll be an MNC, there'll be auto, there'll be stocks, there'll be ETFs. Multiple elements are brought into a portfolio. What I find with people is that because they set a very near-term objective, they start going granular into one investment and saying, why is this not going on? That particular investment might have a longer cycle time, while something else may have a shorter cycle time. It is never possible that all our investment choices will have a narrow, short cycle time. We need to set a longer investment horizon. That's very, very essential. The next thing we need to do is during this horizon, we need to avoid growing our anxiety. This is something that again happens because we are trying to focus too much on the performance and the returns. However much you and I focus, all our team members focus, the performance will come only to that cycle time. It is not going to get accelerated because the team is set to perform in a certain fashion. And sometimes the performance gets extended. Like when you have COVID, the public banks got mauled, right? Now, if you look at post-COVID recovery after 2 waves, it looks like the public banks are in a better position to recover than private banks, right? You're seeing what's happening in AU Finance, Ujjivan, so many micro of this thing. But the narrative of SBI or Bank of Baroda or somebody like that seems to be better than all these so-called private enterprises which are better placed, right? So growing our anxiety is not going to help, and we need to avoid growing our anxiety. And you also understand when you do this anxiety management that investments are always lumpy. See, in 6 months, pharma went up by 100%. Even today, Nifty has gone up by 58%, but natural resources in the same period has gone up by 78. It will probably go even higher than what it is today. So the performance of infra has gone up 68%. In the same period, the Nifty has gone up 58%. So even when the Nifty does exemplarily well, please appreciate that the performance of your choices will be lumpy. So prepare for that lumpy performance. So if 4 years something doesn't do anything, in 6 months it can give you all the returns. And if you are going to lose up conviction in that critical phase, the advice won't work, right? The advisor would have walked you out, or you might have walked out. I know a lot of people who had spent a long time and then lost their conviction closer to the bottom of the market. It happened. But as an advisor, we hope it doesn't happen, because you invested so much time, you worked hard, you invested time. I believe that time is a bigger ingredient in investing than money. After investing time, if you don't invest a little more time to get the rewards, that is a tragic outcome. That's something which you don't want for anybody. The next thing we are going to talk about, which will ensure that you benefit from the lumpy investment performance, is how you set your expectations. Okay, it's very, very important how you set your expectations. Today, people are setting high expectations, right? When the market crashes, they actually think it's going to go down. They're setting low expectations. But expectation management should happen exactly the other way around, right? After a big fall in the market, you need to increase your expectations. And this is very, very basic and fundamental. Yeah, there'll be a lot of fear all around. Nobody will give you the confidence. What you see on television will be very glum. My way of understanding public mood in the 90s was, if the phone or the broker is always available, you don't have to ring 2-3 times. So if he's always free, then that means the market has got low expectation. And when you can never get his number, market has got very high expectations. So after a big fall, usually expectations are lower. So you should actually increase your expectations, right? That's the way you can make good advice work for you. And after a big rise, you need to moderate your expectations. Like the present market context, you need to moderate your expectations. Whereas I see people saying, oh, Nifty has done so much, I should make more than that. Actually, Nifty has been the most volatile investment instrument in the last few years. And there are specific reasons for that. But when there is a broad economic recovery, then you will see the divergence. And you'll also see that the way Nifty is constructed in a bull market, when the market context changes, the Nifty has to be rebuilt. For example, in 2000, it was tech heavy. In 2008, it was power and infra heavy. Now it is financial and consumer heavy. It will take 5-6 years for them to change the Nifty, because in the peak of the market, they are bringing all these successful companies into Nifty and taking out all the companies which are going to give future success. So blindly thinking about Nifty and setting our expectations won't help. And fundamentally, Nifty as a product itself has a higher risk probably than most of your portfolios. You would be owning gold, you're owning gold mining, you're owning natural resource, you're owning infra. Natural resource and all is trading at a significant discount in valuation to Nifty. The discount is so high, it's unbelievable. It's like the discount we saw in 2008 between infra and FMCG. That is the discount between FMCG and rest of the market today. Okay, the discount we saw between let's say tech and small cap, right, in 2000. That's the kind of discount we are seeing today between financials, right, and that private financials and public financials within financials itself. Okay, and private financials enjoy such a high weightage. Now these are all good companies, but you already rewarded them because you are afraid to recognize the other public financials. So if the public financials come back, there'll be a reversal trade. Now you saw that in one stock pairing. I'll give you a very interesting example where this expectation changed. HDFC was having a significant discount, a significant premium in valuation over ICICI. ICICI was trading at a significant discount for a long time during the episode where they had to change their CEO and stuff like that. But if you look at the last 8-9 months, this calendar year, ICICI has performed phenomenally over HDFC. Why is this happening? Because earlier people were not willing to buy it at all, right? As more people are willing to look at it with an open mind, they're selling HDFC and buying ICICI, or they're choosing ICICI or HDFC. The same thing happened with Axis Bank. In my view, the same thing will happen with public banks also over the next 1 year to 18 months, right? And the investment cycle will start. So we are looking at a very different context where what moves the Nifty, right, may actually not perform as well in the future as it did in the past. And what you own may actually perform. So you should set your expectations knowing these factors. You should not be blinded by what the market narrative is, because market narrative will eventually change to what is already in your portfolio. That's what happened in pharma in 2020. That's what happened in infra this year. That's what happened in natural resource this year. That's what happened in gold last year. And that's happened in FMCG and many other themes earlier. This will happen. So you have to basically be ready and wait. How can you do that? You should not let daily and monthly movements cloud your confidence, because the noise is just too much, right? Somebody telling you at this valuation that Asian Paints is a must own, it's not unusual. I was told the same thing in 2000 on Wipro. They had zero tech stocks. I had respect for tech companies, but not for the valuation. 2008, we had zero infra, zero. I didn't have a single infra stock, but I was buying FMCG and Lever and those companies, which went up like a Pidilite. All those companies we bought in 2008. 2009, 2010, when they were trading at low double-digit valuation. Today they're 100 plus P. I don't even know the multiple. It's so high that moving every week. But if you allow this noise of the market come into your thinking, it will cloud your confidence. You will not believe in your stocks. You will believe something which you don't own is going to do better. Seeing the recency, right? Don't allow that bias to cloud your confidence, because in the end, if you are not confident, the advice cannot work for you, right? You have to be confident of the advice. If you're not confident, or if you're half confident, it won't work, because these are all high conviction advisory models. The only way it will work is if your confidence is really at a high level. It has to be high. There's no other choice. And the only way we can manage it is by not allowing the daily, monthly movements cloud your confidence. It's important that we manage your expectations correctly. When markets rise too fast, we need to moderate your expectations. When markets fall, we need to increase your expectations. You must become more bullish on the asset class, must be willing to take risks. And you must understand that the investment performance in a model like ours will always be lumpy at the theme level, not just at the portfolio level. So each theme will fire, and then we go to the next one and build the next one. When you build the next one, it will take time to build the next one, and that will again fire after a gestation. So it's important you should avoid growing your anxiety, because this whole model is a gradual model where you scale up, exit, and then again scale up and exit. And you definitely need to set longer expectations. Now I'm going to talk to you about where our RIA sees opportunity. It's very important where our RIA sees opportunity. In 2010, when we started advice, we chose only mutual funds. It was very easy to start in equity, but we started with mutual funds because that was an under-researched part of the market. It remains under-researched because the quality of research in the industry is still low. I'll give you an example. People pay and subscribe to various services. One such service gave a negative call on Franklin India Blue Chip just at the time when SEBI was looking at how to solve the debt crisis in Franklin Templeton Mutual Fund, right? At that time, so now the paid advice gave a very detailed report that you should exit. We have been tracking Franklin Blue Chip for academic reasons, because we know this fund has been there for nearly 28 years. It's done very well for a very long period of time. So I was very closely tracking the portfolio. We had very granular detail and understanding about each stock holding, what is the position size, how they are constructed the portfolio, how that performance will happen. So when we were seeing this performance, it was very clear to me that it will probably beat the Nifty by miles. And here was a research firm telling them, get out of it, right? So actually, I did even a video on this saying that, you should buy this. Not to really refute that advice, but to put this in perspective because I had very high conviction, right? So this was the reason we came into mutual fund research 10 years ago, and this reason remains stronger even today because mutual fund research is completely rear view mirror driven and nobody is looking through the windscreen. So we, in that sense, are different from the fraternity in our research, and we are definitely looking at every fund house through the front screen, right? Every scheme through the front screen. So we are looking at the runway, the future, and how we will travel in the future rather than looking at the rear view mirror to decide how our future journey is going to be. So that is why we still believe that mutual funds will remain a very important part of our portfolio, but we have definitely grown this model significantly in the last 4 years. First, we have brought in gold because of the nature of the economies around the world, the level of liquidity, the level of money printing, and what we believe will be monetary policy in the future. We feel that the safety of the gold cannot be ignored at all. The next part where we are having very high conviction is in the infrastructure momentum in India. When you go to a petrol pump, you get very angry that you are paying so much money. 20 rupee 50 paisa out of every liter of petrol that you fill is going towards India's infrastructure assets directly, right? And this sum adds up to anywhere between 4 and 5 crore per annum. So over the next 4 years of this government's tenure, you will see 20 lakh crore going into infrastructure, and that's only from the government. And you can see a lot of private investment happening also. So I believe that the infrastructure momentum is here to stay. The same thing we did in 2010-11 when we started this venture. When we started ithought, one of the first themes we went in was tech. So I had friends of mine fighting with me saying that in 2000 you were so negative on tech. Why are you positive on tech now? It's a mature business and stuff like that. We felt the valuations are very good. The companies had very good corporate governance. They were growing fairly predictably, and all this was not reflected in the market's assessment. Similarly, now I believe that infrastructure is in a very sweet spot. 2008 was too soon, too early, lacking in governance. Most of the guys who didn't have governance are gone. The big guys in this industry like L&T are now improving their governance, and they need to do it. They don't have a choice. So you are going to see a new infrastructure industry funded by InvITs, funded by global capital, which is going to boom, with government being the primary spender, giving us full visibility of what they're going to do. I think that it's fairly easy to bet upon, and it's not such a complicated bet as it looked in 2008. So return of infrastructure momentum is another place where we see huge opportunity. The third area where we see opportunities in global themes, this is something we tried last year to scale up in NASDAQ. Unfortunately, we didn't convince you enough. We didn't manage to convince you enough, but we are still doing it again. It's happening in two areas. It's happening in world gold, in mining funds. We are buying the mining funds because we believe that their leverage is lowest and they're going to make the highest profit if there is any change in the global macros. And if there is any change in monetary policy, we believe that they will do very well. We are looking at mining as a contra call. We are looking at a lot of global themes. We looked at China just a week ago. We just said we will see it for some more time. Global investing is going to increase. That is going to become an important part of the ithoughtRIA in the future. A lot of work is happening. We had our analysts show me nearly 100 global ETFs, mostly in the US. We have studied so many ETFs. There's so many thematic opportunities. So global is something which we want to look at very closely so that when global markets correct, then we would be able to choose one or two themes which can make a huge impact to your wealth creation. So that's something which is work in process. A lot of work is happening. We are doing a few investments for you. For all you know, we may be able to even do a global portfolio sometime in the next 5 years for some of you who have the risk appetite and the capital. So global is another focus area where we are encouraging you to participate. And the next area is very, very interesting. It's ETFs. Here again, we are looking at the entire domestic ETF space, right? And we are looking and doing a lot of work in the ETF space. The reason why we encouraged you to move to a higher version of the ithoughtRIA, which is ACE, is that we would be able to bring in ETFs and make a significant difference to your investment performance. This will do two things. One, it will lower your cost, and second, it gives us an opportunity to buy with a very low impact cost. Third, we are buying very high quality concentrated baskets in sectors, teams, and stuff like that. And even the index, it's not just one index. There are so many indices. We could buy the indices which we like. So ETF is going to be a very, very important component of our RIA in the future. And we see a lot of opportunity in the ETF space. The next part where we are looking at is in smart indexing, where we believe that the index will become a very critical part of your investment. Many of you are seeing a pair of two indices in your portfolios. That's something which we have tried very successfully in the last 7-8 months by buying two index products and then creating a portfolio of large cap for you. Okay, so what does this do? We believe Nifty is too concentrated, right? I said in the beginning of this conversation, but that doesn't mean that I should keep you completely away. So I want to create a portfolio which mitigates that concentration risk of the Nifty and yet makes you participate in all those companies which are large cap. So that we do through smart indexing by combining a few ETFs or few index ETFs and creating a new large cap portfolio. So that's what we have done, and that combination has done phenomenally well. And when we do that, we see that new portfolio which we create, and seeing that portfolio, we make our decisions. So there's no point looking at the index, right? You may ask, why are you buying this index at this level? The reason is that we believe that the two products or three products which combine to create an ultimate portfolio manages the portfolio risk in a superior way. So that is how we are creating smart indexing. This is a very, very interesting aspect. We could later create some products which are just smart indexing products, but today smart indexing is a very important concept and a very important component of your RIA. Here again, cost reduction is a given. That is something we are very, very active about. Last but not the least, what we are trying to do today in AS RIA is that we want to buy stocks to the extent of somewhere between 10 and 20% of your portfolio. And it will be a highly concentrated stock selection, well in keeping with your risk appetite, of businesses which have high growth potential. By doing this, we believe that we will be able to raise the overall performance of the portfolio and also add a layer of very high performance to the already existing performance model of ithoughtRIA. So all this we are going to do in one product, which I call as ACE. You are all familiar with ACE. ACE is a 50 lakh product. A lot of you are in the zone of 25 lakhs. A lot of you are well above 50 lakhs. Those above 50 lakhs are already signed up. You will see your first investment start now, and over the next 2 years, we'll build the last three components, that is stock, alpha, smart indexing, and ETF. And layer by layer, we'll do that. We'll continue to bet on the other things, and you will see a completely different advisory experience over the next 3 or 4 years. We have already done all the groundwork for this over the last 2-3 years, and we are fully equipped, and you will see how this works in the coming years. But for that, we need scale. We need at least 50 lakhs. So what are we trying to do? We want investors who are at 25 lakhs to invest gradually and raise themselves to 50 lakhs. When they cross 50 lakhs, we'll open an AS RIA account, which means we'll start a demat account and then bring you into that phase. But between 25 and 50 lakhs, we will still do the smart indexing. We'll still do some ETF teams, which we can do for you, so that you start getting that experience. But to buy stocks, we need 50 lakhs. The simple logic is, if I have 50 lakhs, I can buy 5 lakh or 10 lakh worth of stock. Buying for lesser than that doesn't make any sense for us. We'll not be able to allocate sensibly. So it's like, I can't cook a meal in this teacup, right? It's very difficult, right? Likewise, even you cannot cook a Maggi noodle in this teacup. So you need some basic economies of scale to create such a diversified portfolio where so many things are there. Unfortunately, we cannot do it at 25 lakhs or lower than that. So when somebody comes to that scale, we'll be able to bring that entire sophistication to work for you, and you can run that sophistication for years to come. So that is basically where we stand, and that's where we see opportunity. Let me sum up where we see opportunity going forward. First, from stock alpha, we will get the higher return velocity, and we will also buy great businesses. We will not buy risky businesses. Second, smart indexing is going to create a superior large cap experience for you. We'll combine funds and create a portfolio which manages the risk in a much better way. So if Nifty looks expensive, our smart investing has the capacity to take care of that. Then we are looking at ETF themes in domestic and global, which will give you a vast hunting ground for investment opportunities. Just completely opens up the investment universe. We are also looking at global themes through mutual funds, feeder funds, which is again giving us very big hunting ground for opportunities. We are very bullish on the infrastructure momentum of the country for the next few years, which is why we are pairing natural resource and infra in your portfolios. If the markets fall, we believe that our very high exposure to gold is the perfect cushion. We can always move from gold to equity if we need, or we can book some profits in gold and still wait. So gold is the insurance. What we are doing in our mind in your portfolio today is leaving gold out and trying to earn the entire returns from the 80% or 85%. That's exactly what we're trying to do. And we've done very well, considering that we've taken lesser risk during the entire COVID wave and still managed to do as well as we did. We have not bought any Ambani Adani stocks. We have not bought expensive stocks. We are not in an investment universe which is going to time correct for the next 10 years. We are right in the middle of where benefits will accrue if economy grows again or starts growing in a higher trajectory, right? So that's where we see opportunity. With that, I would close my presentation and we'll open up for interaction. Before we close, I want to thank each of you for being with us during these 11 years. But for the high conviction of our investors, I don't think we could have built such a model of investment itself. It's entirely due to the investors, but the eventual outcome should be that the investors also show higher conviction in increasing their scale, right? When we scale up an investor, then we are able to do much more. Our skill sets have scaled up significantly. A lot of our investors are yet to scale up to take advantage of the skill sets that we have built. My only hope and aspiration is that the investors understand all this and over a period of time keep on doing things which help them scale themselves up and achieve better benefits and realize the full potential of what we can do to serve you better. Thank you very much. Now, there is a question on PSU. See, I mentioned that 2003 changed the entire PSU perspective. Personally, I think 2023 will be a repeat. But before that, a lot would change even now. So we're going to see a lot happening in PSU. One or two companies getting sold will completely alter the valuation paradigm of the entire universe. And you are very well positioned because the PSU funds is so underowned. Nobody has it. I'll give you a very simple statistic. In the PSU fund universe, right? There are a few funds only. In two of the funds, we are the largest investors. In the third fund, the AMC is the largest investor. There's no public interest at all, right? The AMC has put its own money in one fund. In two of these funds, we have put our money. So that is where it is. I believe that we are very well placed for an uptrend, and whenever it happens, we should be ready to capture that. Can you give 1-2 examples of ETF themes? There are plenty of themes. So, for example, I played pharma in the last cycle through a mutual fund. I believe the next cycle I'll be able to play it through an ETF. As simple as that. In the past, I played FMCG through a mutual fund. That mutual fund went and bought companies which we were completely disliked, right? At the top of the cycle, they went and bought companies which went broke also in FMCG. Imagine an FMCG company going broke. At that time, what we were forced to do is take the hit, right? But if there was an ETF in FMCG, I would not have had to do that, right? So that's simple. So today your so-called quality strategy, right? so-called quality strategy is so expensive. I can play the same strategy through ETF at the lowest cost. It is possible. So it is possible to use ETF in full leverage for your interest. And we are working with the ETF industry very closely and asking them to create ETFs on indices, right? So we are doing that. We are reviewing. A lot of homework is happening, a lot of interaction with the fund managers, with the product specialists, because unless we work with the product specialists, we are not able to get those schemes. Navy is coming out with a Vanguard. See, I believe that Vanguard has an American context. I don't think India has the corporate governance of America. So it's very important that we don't automatically leverage this as going to be successful. We have to look at the schemes, look at the products. We are yet to start. It just announced one day ago. So we will look at it. We are very agnostic. Any product, ETF, we'll study the ETF. To us, the ETF is the driver. If it has got a good portfolio, we'll buy no matter who offers, and we'll look at the cost and buy it. That's about it. There is no preference. Just a moment. A lot of questions coming. How much to allocate to each specific theme? So I mentioned that the starting themes will be between 3 and 5%. You should not delay that, certainly. Over a period of time, we will always encourage you to take our positions higher and bigger when the conviction goes up and when it moves down. Suppose the valuation goes down, we must increase our position. We should not say it has come down, I don't want to buy it. When valuation is more in our favor, we must increase our conviction. What is your position on FMCG like ITC? Well, ITC is a retail investor stock. I did study ITC very closely in the last few days. On 15th July 2017, the valuation of ITC was significantly higher than Hindustan Lever. It was 330 stock price. And it was some 30-40% higher than Lever. Today, Lever valuation is 3 times ITC. So that is ITC in the last 4 years. So you can believe that ITC will perform miracle. But for that, a lot of people have to smoke more. More people have to smoke, and more people must smoke more, because that's the only hope for ITC now. FMCG is the FMCG business of ITC. If you want to give it a parallel, I will give Rahul Gandhi. So you can make your own judgment. No, they are not. This is the advisory thing. PMS portfolio is not meant to buy leverage companies. Somebody is comparing PMS and RIA. They're totally different. You need to complement. The PMS portfolio is a very simple portfolio where we are given an investment style which will suit you, right? I am not. So there are 3 products. All 3 are having one overarching thing, that we will buy very high quality at reasonable valuation. That's the thing about all the 3 PMS products. So the risk taking in the PMS is actually lower than the RIA, and they are very clear and very well positioned products. RIA has got very vast scope. Its scope is very vast compared to the PMS, and it is definitely going to be a very effective way to manage your wealth together. Both can complement each other. A lot of our investors have both. One moment, there's so many questions. Just a second, scrolling. What's the difference between ETF based themes and corresponding MS based themes? The cost, and also the way MFs are managing. There are a lot of cases where fund managers get carried away by companies, and ETF doesn't get carried away. So ETF is more, it's a colder investment model than fund manager. Fund manager is very emotional. Already have an equity portfolio turned over to ithought for reaching the minimum. We can help you get your starting capital. Yes, we are not taking portfolio, we are taking only cash, because suppose that portfolio has even 1 share in a company which let's say I own personally, then I can't do anything with my holdings or with any of the other proprietary holdings. So we help you deal with your portfolio and then take the money into the PMS. That we can help you. Therefore, ITC, switch ITC, exit ITC and switch to other counters? No, it's a cash proxy. Whenever it goes up, we'll sell. That's it. It's not a worry. It's a very small position. There's nothing to worry about ITC. ITC is cheap. Instead of cash, you keep it, you will get 5%. Liquid fund gives you 3%. That's all. What is the view of domestic tech companies' growth in the decade? Yeah, they'll do very well. But again, I think domestic tech companies are getting into a mini 2000 moment where wages are going to go up like anything. Growth is happening, but I don't know whether the rupee will be the spoiler. So it's a very delicately poised state for domestic tech companies. We will watch. We will watch. Natural resource still have potential. I think you should watch this quarter's result and then we'll decide. As of now, there is no evidence to the contrary. In considering current situation, would a significant percentage of portfolio move to global themes? No, see, the entire market is expensive. So you need to build positions gradually. There's no rush to build a position of global. I don't agree that you just sell here and put everything there. That such rash and hurried things are not going to work. We need to work very, very systematically and gradually. That is what I think. There's no rush. You have to build incrementally. Global themes imply US or all major countries. China. Yeah, we can buy in any market. We can buy in any market. We have studied some China funds. We've done a lot of work. Any market you can invest. When you say global, you can buy in any market. I'm currently investing. Parents are currently fully investing in FD. For FD clients, we can give you some bonds if you don't need the money. If you need the money in between, then we can give you some bonds. Yes, you can build a part of your portfolio through mutual funds and ETF. It is possible, yes. So that you're able to overall increase the returns. See, there is one fundamental mistake I see in investor behavior. You're taking out all the money from a fixed deposit and putting it in an equity mutual fund, right? Because you think the return in fixed deposit is low. That alone cannot be the reason. See, you need to basically build an equity portfolio which will complement your debt portfolio and increase your overall returns, right? If somebody is 70 plus, he can have 30-40% in equity, not more than that, right? So you need to complement these two things and operate. That's what you need to do. No, see, I think that we cannot rush into buying these Chinese tech companies because its government is a black box. So we have to study. When we see this problem is receding or we are confident that all the negatives are in the price, we can buy. But I think that understanding level has to be much, much more elevated. See, ULIPs, for a younger person who wants to invest in a certain way, they may be useful. But it's very individual specific. There is no plan of really expanding too much into that space. But for a few people, depending upon their taxation, for a high taxed young person, ULIP may be a good option. But otherwise, I don't see ULIP becoming a product for an older person. Chemicals. See, when a sector invests very heavily in its capex, the operating word after that is gestation. Stock market is behaving like it hasn't heard of that word. Good luck, let us see. To me, project gestation is something which you cannot escape. When there's project gestation, there's earnings gestation. But if you don't have valuation gestation, then how these two will affect that, I don't know. I'm not sure that it's a safe thing at this point. Yeah, somebody in his 40s, it depends on the goals you're saving towards. See, suppose you have to, you have very heavy lifting to be done, like children's education abroad or parental health or any heavy lifting to be done in your 40s. then the mix between equity and debt depends upon that. Suppose you already bought your house, you already provided for your children's education, your elders are taken care of, you're only growing wealth, then you can have a higher equity. So debt component is based on how much risk you can take. Everybody in 40 doesn't have the same situation. Yeah, there will be multiple situations which vary from each person, and according to that situation, you need to adapt. It will be unique to each person. Real estate is going to be very critical. See, the way I look at it, um, investment world always is very good at narratives. First narrative was building materials. I played real estate for 9 years from 2010 to 18 through the building material route. Okay, in 18 I sold out. Again from 20 building material is being hyped up. I have not invested in building materials much. I have one or two, but not okay. Those investments are large, but not. I don't have too many investments. In my opinion, there is a new narrative which is coming, which needs more empirical validation. That is, that more home buying will happen in particular segments where people are upgrading houses. In my view, one part of the real estate is going to do very well is affordable housing. That will do very well, right? I think that's a new segment. So there are people who don't have houses who are going to buy houses. Affordable will do very well. But I don't know about this high-end housing. That is a unknown quantity. Middle class housing is an evergreen thing. So it will keep happening. FSI is being raised in various markets, which means that cost of land will come down. Naturally, demand will go up. And old assets will also get reconstructed. You'll have old assets getting demolished and rebuilt. So that will also happen. Where are we in the commodity cycle? As far as India is concerned, we are in a phase of very high demand growth, because if you're going to put 5 lakh crore in infrastructure investment every year, and if new factories are going to be built, if your solar is going to be so huge, if EV is going to take off, so many new factories are going to come up in various industries, I think that commodity demand should be good. The only mistake that happened in the past commodity cycle, capacity creation was huge. When the commodity boomed in 2008, capacity creation was huge. Naturally, when the capacity came in, the demand was not able to, take that capacity. It was not able to feed the capacity, right? But today, there is hardly such a capacity pipeline that we are seeing in many commodities, except chemicals. So as far as metals and are concerned, that's not a big issue. Cement, yes, there is capacity coming up, so there could be some worry. So it's all dependent on each area. So I don't think that commodity in India will go back to where it went in 2020. So it will be somewhere between where it is today and there. And if the companies are able to create very high cash flow, then the re-rating will happen, because the enterprise value of commodity companies is lower today than it was pre-COVID, especially in steel. A lot of companies are having a lower enterprise value. So that has to change, in my opinion. Yeah, capital goods will suffer high commodity prices. It's not healthy for them. But over a period of time, they will get better prices, and they will have to show the ability to price better. Pricing power has to come for them. That will happen when the demand goes up. It's all a function of demand. So if more investment happens, capital goods will start being able to pass on. At the moment, I think the current commodity prices minus 10% is likely. Plus, I'm not even factoring it into, I'm not factoring an increase in commodity price. If there's an increase in commodity price, then you can see a very different market. I'm not even factoring that into my calculation. Current commodity prices, current cost structure, and same demand with usual year-on-year demand growth. That's all I am factoring in. That looks a reasonable expectation to me. If the price falls 10% also, commodity companies will do reasonably. That is my expectation. Yeah, RAA is linked with individual goals. Absolutely. RAA is linked with individual goals. It is possible, provided you do a financial plan. Yeah, thematic ETF, FMCG ETF, power ETF, infra ETF, as the form, we can always go into them in the future. So I think the point is people are thinking that ETF means simplification. No, I've seen the American market. ETF is so complex. There's so many ETFs that unless somebody knows how to analyze the companies, it's going to be more sophisticated than equity investing. So we will have multiple opportunities to do that, and it's very interesting. In fact, ETF is going to expand the advisory space like never before because the kind of variety we can offer, the kind of options before us is huge. So you need to have specialization to do that. In the current context, the advisor has a huge gap to fill to be ready to act, give advice. Whereas in the market, in the media, the narrative is that the investor is ready to do it. I don't know how. I mean, it's oversimplification. I don't think even the journalists who write on ETF know about the ETF. So that is my assessment. High inflation is always bad for stock market. High inflation is what brings stock market down, always. See, I have conviction in parts of the equity market which are looking attractive to me, not in the expensive parts of the market. So you cannot have a generic approach to equity. So in 2009, I was buying FMCG. If I said that infra funds are very expensive, I won't buy anything. I would have missed buying lever and Pidilite at those prices. Whereas people are buying lever and Pidilite today, which I don't subscribe to, right? So I'm saying that go to that part of the market where it's very cheap and buy something there. That is the basic difference. The market and your investment portfolio need not be the same. You can buy something which the market is not looking at all. No, I don't think the fear of interest rising rate is overrated. If inflation is uncontrolled, rates will rise. But it is too much to oversimplify that rates have to rise, right? If we are able to manage it better, well and good. There are two other factors in this. One is the exchange rate, right? So in the past, the countries actually let their exchange rate fall, and that complicated the inflation further. If countries manage the exchange rate better, then if they allow it to rise, then inflation will not become the enemy. In the past, we have allowed exchange rate to make it worse. Franklin will beat index in future after it. See, at the moment, it's tired of the index is 58% and it's on 74 or something like that. That's a massive beat in the last 1 year, right? So for that to narrow, it will take time, no? Don't immediately when you're so high, that gap to narrow will take time. I'm just giving an example of how in a situation you have to see it differently. That's all. I'm not giving you a forward-looking statement. How many number? No, there is no number, no, on thematic. Thematic doesn't mean a high risk. Thematic can also be moderate risk, no? It depends on the valuation you buy in. In 2020 January, pharma was a moderate risk theme. Financial was a high risk theme. Nifty was a high risk theme. Whereas in the market, in our narrative, it was the opposite, right? That's like it. Theme doesn't mean expensive. Oh, thank you. You like the paintings. Yeah, we have asked for a silver fund also. We are talking to, we want a silver ETF. We have asked, but it has to come. We'll wait. We are talking. It's not in our control. No, somebody has to launch a product here. So if they launch, we'll buy. All right. Thank you very much. It's been very nice that all of you have spent close to 90 minutes almost with us to appreciate what we have to say. We do hope that we'll be able to grow on this and do a few things right for the future. And hopefully, when the market falls again, all of us will approach it with much greater conviction. Thank you very much.